Hello, everyone. Thank you for joining our monthly discussion group. I'm joined, as always, by Michael Schneider. And today we have a special guest, Wayne Cooper. So we have an interesting topic this month discussing inherited IRAs. There's been a lot of confusion around the changes. And for many of you listening, this is going to apply next year, some of these changes. And for those of you that this doesn't apply, that have retirement accounts, this will apply in your future planning and estate planning overall. So with that, let's start with the topic, Michael.
Sure. So again, you look at a 401k, a Roth IRA, inherited Roth IRAs, traditional IRAs. There's a lot of different retirement accounts out there. As Jared mentioned, we want to really focus on the inherited IRAs today. And so when you look at what an inherited IRA is, it's inherited, or it could be called a beneficiary IRA. It's a retirement account that you receive from generally someone that's not your spouse or partner. Sometimes a good example would be a grandchild inherits a IRA from a grandparent. And prior to 2019 and some changes in IRA rules, when you inherited an IRA, you could take minimum distributions each year based off of your life expectancy. And this was called the stretch provision. So it was a little bit every year, throughout the rest of your life. So what really changed in 2019 was really with the Secures Act that got passed. So Wayne, can you talk a bit about that act and really what it meant for inherited IRAs?
Sure. So the basic change was they eliminated the stretch provision. So beneficiaries can no longer take minimum distributions over their own life expectancy. This becomes more of an issue with younger beneficiaries because we were able to give them a little amount each year over a long period of time. They've also eliminated the 5-year rule, which said you don't have to take annual distributions as long as you liquidate the account within 5 years. What they put in its place is a 10-year rule for withdrawals. So in certain circumstances, there's actually an annual distribution that's required during the 10-year period, and then the balance can be taken out at the end of the 10 years. In other situations, no annual distributions are required, but a full liquidation of the account must be made within the 10 years. So the distinguishing point is if the IRA owner was past their required minimum distribution beginning date before their death, then the beneficiary is required to take annual distributions and must deplete the account by year 10. If the owner was younger than that date and was not required to begin distributions, then all that's required is depleting the account by the end of the 10 years. Now, note that for Roth IRAs, because the owner does not have a minimum distribution requirement, it's assumed that the owner was not at the required age when they die with respect to Roth IRAs. Therefore, Roth IRAs inherited still no annual distribution, but must deplete the account within 10 years.
And Wayne, if you look at one of the main reasons the IRS made this change is they're going to collect tax revenue sooner. Because when you look historically, the majority of inherited IRAs stretch that tax liability over the rest of their life. So in many cases, there was 30 years if that was your life expectancy. So the IRS was collecting a little bit of tax revenue. Here, as you stated, every retirement account has to be depleted one way or another by the end of 10 years. So it opens up a lot of different planning topics that we want to discuss. The other thing for the RMD age, the change that was made in Secure Act 2.0 is it increased the RMD age over time all the way up to age 75. So this distinction you're making, Wayne, between before and after is going to become a bigger and bigger deal as that RMD age grows to 75 over time.
Correct. I think the IRS has made it clear that IRAs are intended for the retirement of the person who established the IRA and not for the retirement of the beneficiary. So once that purpose is no longer in existence because the owner died, the idea of forcing quicker distributions is consistent with that plan.
And another thing just to note is that these changes, these rules only are apply to inherited IRAs from after the Secures Act was passed. If you inherited an IRA prior to 2019, you're still able to take the distributions over your life expectancy. So that is one distinction for that this really only applies to newer inherited IRA accounts.
Correct.
And obviously, there's a lot of the different rules, different moving parts that come along with this, and there has been a lot of confusion as well. So what the IRS did is that they did waive the penalties from if you did not take out enough from your inherited IRA in 2021 and 2022, and then they also recently announced they were waiving the penalties on the distributions as well in 2023. Now, Wayne, does that mean that you have to go back and take the distributions from what you would have needed to do in 21 and 22, or do you sort of start fresh moving forward?
Well, a little combination of the two, in that you do not have to go back and take distributions for 21, 22, and 23. However, when you determine the amount of your distribution from 24, you have to subtract whichever of those years applied in determining your required distribution. So now you base your required distribution on your age as of the date of the death of the IRA owner. And then each year you would reduce one from whatever that factor was. So if your factor was 30 at the date of death, it would be 29 in the second year, 28 in the third year, and so forth. So you do have to reduce it by those three, but you do not have to take those 3 years of distributions.
Thank you. And so when we look at the inherited IRAs now, we have a couple planning ideas. And the first revolves around if you have a traditional inherited IRA. And I think the basic idea is that we think it's best to really schedule withdrawals over that 10-year period and just pay a little bit of the taxes along the way while you are in a lower bracket. And really, I think our main goal is to avoid having a sort of a giant balloon payment for taxes in year 10, where you are paying taxes on the distribution of the initial amount, plus the 10 years of compounded growth that you've hopefully received during that time. And again, if you are in that situation and you do have a very large IRA account or inherited IRA account, that we want to avoid as much income in the top tax bracket as possible. So whether it's the first year you take a 10th, and the second year a 9th, and 8th, and 7th, so on and so forth, it is an efficient way to I'd say pay a little bit of taxes along the way, while also still allowing the account to get some of the tax deferred growth.
And Michael, with that, it's a real big challenge with this change, because it used to be much easier to plan that small distribution every year. This really has opened up a lot of different options to discuss as this one, because the big challenge is, like you said, all that tax money has to be out by year 10, and it's just a lot more thought and planning needs to go into which route you make. So for example, you could do a lot along the way, or if you're about to retire and you're going to have less income after you retire, maybe you take the minimum distribution, but then accelerate once you're retired. So there's just a lot of thought and planning that needs to go into these inherited vehicles compared to what they used to be.
And another planning idea, and this would be something that you do if you have an IRA and while you're still living, is look at a Roth conversion. And Jared, you talk a bit more about some of the benefits of converting to a Roth in this type of scenario.
And this offers a lot of advantages considering the change, because when you look at a lot of the advantages with the Roth IRA, and again, high level, what you do is you move your IRA money, pay the taxes today, whether it's out of the IRA directly or with other money outside of your IRA to pay the tax. Then once it's moved into the Roth IRA, you could see a lot of the advantages. You get tax-free growth as long as you're living, number one. But then when you pass away, the advantage you get from the beneficiary standpoint is they now receive 10 years of tax-free growth, because they don't have to take the minimum distributions, as Wayne mentioned earlier, and you could deplete it all in year 10 with paying no tax. there's no minimum distributions. And when you look at the tax-free account, it's just a huge advantage. And then Wayne, one of the other things that's interesting from a tax planning standpoint, if you're in a taxable estate, is the income tax paid conversion. If you could talk a little bit about that.
Sure. So when you convert to a Roth IRA, you pay tax on the full balance of your traditional IRA. And by paying the tax while you're alive, that reduces the amount of your estate subject to estate taxes. So you'll see in the example we've put together, the effect of saving the tax, the estate tax, on the income tax paid. So
if we look at that example now, to lay out some of what we were thinking is if in this example, let's assume that we have a taxable estate, and at the end of the day, the only monies left to pay the estate taxes are $1 million in an IRA account. And just some of the other general assumptions we have is that your income tax is at 30%, 40% estate taxes, and that we have an assumed growth rate of 5%. So Wayne, can you walk through the differences between not doing a Roth conversion and doing the Roth conversion?
Sure. So although we're having the taxes paid from the IRAs in these situations, we did that more for comparison purposes. Normally, it would always be best to pay the tax with other assets so that you can continue to get the tax-free growth on the larger amount. That doesn't change the numbers here for what we're trying to illustrate. So we just made it simpler to keep the taxes out of to pay the taxes out of the IRA. So if we look at the column on the left, which says no Roth conversion. So we have $1 million IRA balance. And obviously, there'd be no income tax on the conversion because something was withdrawn. But then at death, we have $1 million asset, which we're assuming is in a taxable federal estate, which is subject to a 40% estate tax. But because we have to withdraw the 40%, we have to pay what we're assuming is a 30% income tax rate on the withdrawal. So not only do we have to pay the tax on the estate tax, but also on the gross up, so we net $400,000 to pay tax. So when we take that withdrawal, there's a total of $428,000 that are left for the beneficiaries. Now we've assumed an annual growth rate of 5% over a 10-year period, and in such a case, we'd have a total of about $797,000 left. At an income tax rate of 30%, there'd be a $209,000 income tax liability on that distribution, meaning the heirs would net $488,000. Now we go to the Roth, we still have the $1 million, but we have to pay 30% of that on the conversion, leaving with $700,000. We now only pay estate taxes on $700,000, which at 40% is the $280,000, and you can see right there the estate tax saving is $120,000. That's the 40% of the $300,000 of income taxes paid. That nets $420,000 for the heirs. With the assumed growth of 5% of $264,000, you'll see at the end of the 10 years, the net to the heirs is $684,000, almost a $200,000 benefit for the heirs by doing the conversion. So we encourage most of our clients who are in a taxable estate to strongly consider the Roth conversion just for the benefit of the tax savings for beneficiaries. Not everybody likes to pay taxes earlier than necessary, but the idea and the strategy is always to try to pay the least overall, regardless of when they're paid.
And when you look at the rate of return assumption, I mean, you can get 5% in treasury bonds currently. So if you invest for longer term growth and you take that rate of growth up a little bit, you could see even a further substantial benefit with the Roth option. And when you think about all the planning that goes into either this or the inherited IRA, these are very complicated and the changes are. So we wanted to take some time to explain that today. Each situation is different, and it's good to compare and walk through your individual scenario. But as always, we're trying to stay ahead of where things are going, and feel free to reach out individually to discuss your situation to plan around these, because it's much more complicated than it was before. But there's a lot of benefit to your family ultimately for planning the right way. So with that, we want to thank you for tuning in this month, and we'll see everyone next month.
Thank you, everybody.
Thank you.